In this video, we're going to be going over a few of my all-time favorite investment options for beginner investors. We're going to be diving into ETFs or index funds. I have a few options selected here that I want to share with you guys. And the idea here is that if you're looking to take a passive kind of hands-off approach on investing, not going out and picking individual stocks because you don't have the time, the energy, or maybe the knowledge, these are the types of funds. Again, do your own research, but these are the types of funds, in my opinion, that you can kind of select, set it and forget it, and they can help you reach your investment goals. Diving right on into fund number one, we gotta go with VFV. This is a core, a staple in so many investors' portfolios. VFV is, of course, the ticker, so this is what you'd be going and punching in when you go to your brokerage account, Wealthsimple, Questionnaire, whatever it is, to purchase it. This is the Vanguard SP 500 Index ETF. Now, Vanguard, this is just the provider. There's a bunch of other providers out there. In fact, we're going to cover a few of them in this video. The one I've selected today is Vanguard, the most popular, I believe, most popular S&P 500 fund here in Canada. For those that don't know briefly what an ETF is, let's backtrack. ETF stands for an exchange traded fund. The best way to think of this is it's like a basket of assets. Okay, so you can buy a basket or a bundle, and all these ETFs can invest in different things. You can buy different baskets or different bundles. This is an ETF that focuses on the S&P 500 index. And as we'll see down here at the overview section, the Vanguard S&P 500 Index ETF seeks to track, to the extent reasonably possible, the performance of a broad US equity index. And it's essentially tracking the S&P 500. If we're to scroll down to the holdings to understand what we own within this fund, because it's very important that we understand what we're investing in inherently by buying this fund. Well, this fund owns, a number of stocks, 500 different investments. In fact, actually we see 504. Let's just call it 500 for the sake of things. Within this one ETF VFV, you are getting exposure to 500 different companies. Notice here, all in North America, actually more particularly, all in the United States. So this is a fund giving you exposure to the United States of America. You'll actually look, if we break down the holdings here, which is really probably the most exciting part for a lot of you guys, you're gonna see the biggest US names. Happens to be a lot of tech as of right now, the Magnificent Seven, some of the largest stocks, maybe a term that you're familiar with. But looking at the time of filming today, the largest holdings are companies like Microsoft, Nvidia, Apple, Amazon, Meta, Facebook, formerly, Google or Alphabet, Berkshire Hathaway's, Eli Lilly and Co., Broadcom. These are just the top 10, but of course you're getting exposure to 500 other investments. You can already start to see one of the major benefits of ETF or index fund investing in that you're getting a massive level of diversification. By essentially buying one fund, you're getting diversity to over 500 stocks. I will note there is of course a heavier skew towards, the top 10. Or in this case, tech. In fact, and I'll link this down below for you guys to do your own research and due diligence, but you can actually see the sector breakdown and look at where your money would be essentially deployed or exposed to. We do see the heaviest weighting, about 30% of the fund is currently exposed to tech. We see financials, healthcare, but a pretty healthy scatter across a lot of your major sectors. One thing that I do want to scan up to at the very top, which we did glance over, is fees and costs to this investment. Because every index fund that you go out and invest in, they do have a slight fee. This is what we're looking at. It's the term MER, which stands for the management expense ratio. This fund in particular charges 0.09%. Now, what does that mean? Well, what that means is that for every $100 you invest into this fund, you're going to pay essentially 9 cents in fees. Now, obviously you can scale that up, but this is a percentage charged on the amount of assets that you have in this fund, or essentially the amount you invested in this fund. Is that a lot? Is that a little? This is extremely marginal. This is one of the lowest cost index funds out there. This is why it of course makes my list today and why it's such a core staple investment for so many investors out there. This is a very reasonable fee to say the least. It does pay a small yield of 1.07%. Essentially some of the income or dividends, distributions is the actual term that you'll be looking at here. Probably not the main reason why you'd be investing in this fund. The main reason you'd be investing in this fund is to get exposure to those top 500 companies in America. But VFV is by far and wide what I would believe to be one of the staples in a portfolio. And if you were looking at this fund, I would say, hey, look no further. This is an awesome choice. Performance, to look over very briefly before moving on, you will see some stellar performance. You see since inception, or since this fund came to the market and it was available to invest in, it's averaged a return of about 17.16%. Now, Keep in mind, if we look at the inception date, kind of in the fine print here, we notice this fund was incepted back in 2012. So the data we're seeing is from today or till the end of June from 2012. This doesn't factor in the big credit crisis crash in 2008. So is it fair to expect 17% returns, going forward for the next 20 years? I would say probably not. In fact, I wouldn't count on that whatsoever. If we look at the long-term data on the S&P 500 index, it falls in, that 7 to 8% range. You will see sometimes, 8 to 10%, but when I factor in inflation, I think a 7 to 8% range is a very suitable expectation for the S&P performance. And of course, this index fund or this ETF is just tracking that. It's just mimicking what the S&P 500 does. So anyways, that's my take on what to expect, but nevertheless, a very, very suitable fund and what I believe to be a core option for an investor long-term. Jumping on into fund number 2, we're going to switch to a different provider. So not brought to you by Vanguard, but brought to you by BMO Global Asset Management or BMO ETFs. It is the fund ZCN. This is the BMO S&P TSX Capped Composite Index ETF. Crazy name, I know. What's most important here, what should jump out to you the most, is this is a TSX ETF. The TSX stands for the Toronto Stock Exchange. So essentially what this fund is doing is similar to the S&P, but rather than investing in the 500 largest companies in America, this is investing in the largest companies in Canada. As we'll see, we can jump straight down to the holdings, get to the nitty-gritty here. You're going to notice the major Canadian names, companies like Royal Bank, TD Bank, Enbridge, the Railways, Shopify. These are obviously Canada's largest companies. This fund does hold less holdings, FYI, just because it's tracking the TSX, which is a slightly different index. This one has a total of 228 holdings, and entirely they would be weighted to Canada. So this fund would essentially be getting you your broad exposure to the Canadian market. In fact, if we actually scroll down here, we see the geographical breakdown. It is 100% exposed to Canada. Again, you have a little breakdown of the sector allocation, and by nature, the Canadian market and the US market are very different when it comes to sectors. Here we see the largest position being financials. You guys know as Canadians how big our banking system is, and we have the big 5 or 6 banks. Well, that's obviously a critical part of our economy. Energy is obviously higher up as well. We have the big energy companies, industrial materials. This is kind of what Canada is known for. So a slightly different investment profile for sure, but nevertheless an amazing option. And in my personal opinion, having a mix of both the S&P 500 fund, for example, VFV, and a mix of ZCN or a Canadian focused fund, that may complement each other really well in a portfolio, because you think about that, you're capping off all of your major North American exposure. This fund as well, obviously do your own research and decide what you want to do. This fund would, in my opinion, come in at a lower all-time return than the S&P. Again, that's just the nature of understanding the indexes and understanding that Canada is a smaller and less prosperous market than the US. Nevertheless, I do think it's a very suitable hold in the portfolio, and very much like talking about fees with VFV, here you're looking at an extremely low management expense ratio or MER that you'd be paying every year. Here we're looking at 0.06%. So for every $100 you invest, you'd be paying 6 cents in fees versus the 9. Again, you could pick straws between that. These are both considered extremely, extremely low cost funds. By the way, if you are very new to investing, how do you pay these fees? They're going to be factored in and taken off automatically. You don't need to swipe your credit card. You're not going to get an invoice at the end of the year. That's one of the amazing parts of investing in ETFs, is you don't really have to worry about it, but it is important that you are aware of what you're paying so that you're essentially not paying crazy fees that are eating into your returns. The last thing that I will note with the TSX ETF here is you do notice a higher distribution yield or a higher dividend yield. Again, that just comes down to more so the nature of the investments within this ETF. These are two different ETFs. They hold different assets or different investments. The Canadian market happens to be, for the most part, a whole lot more higher dividend payers, especially at the top part of the index. When you think about the banks and energy companies, utilities, versus in the US, you have a lot of tech stocks up there, and tech stocks are not necessarily known for paying great dividends or distribution. Fund number 3 that I want to talk about today, this is an exciting one that I think is, again, a very stellar consideration for a long-term hold. It is the ticker XEQT, brought to you by iShares or BlackRock. It is the iShares Core Equity ETF portfolio. And this is a bit of a change up. This is an exciting one because this is what is considered an all-in-one ETF. Now, what is an all-in-one ETF? Well, essentially, it helps manage your asset allocation for you. And if you're not familiar with that term, your asset allocation, I like to think of as kind of the targets or the breakdown as to how you're going to invest. Some people will invest all into the S&P and they're fine with that. Some people like to break it up. They like to break it up between maybe different sectors, different geographies. Many times as you get older, different asset classes such as fixed income, which we're going to talk about in a second. Well, this fund aims to do that for you, the all-in-one ETF. And if we do scroll down, this is where it gets interesting. This ETF actually only holds 4 holdings. Now, don't be fooled here. You are still getting an amazing amount of diversification because this is what is known essentially as a fund of funds. It's an ETF that invests in other ETFs. So a basket of smaller baskets. Actually, if we look at the number of underlying holdings, so the true amount of exposure that you're getting to actual stocks or equities, you're looking at close to 9,000 investments. So think about that. By buying this one fund, one investment, you're getting exposure to over nearly 9,000 companies. Here are the different ETFs that I was mentioning. So you're getting exposure to ETF ITOT, which is the iShares Total US Stock Market exposure at about 45% of this fund. XIC, which is essentially an alternative to ZCN that we just looked at. It's a Canadian ETF. This one makes up about 25%. You have an international ETF, investing in the international markets at about 25%, and then about a 5% exposure to emerging markets, or kind of these up and coming, more volatile nations, but showing often a lot of promise. These are the 4 ETFs, so the technical 4 holdings. But if we were to toggle over here to all underlying holdings, you're going to see, obviously some of the big names like Microsoft, Apple, Nvidia. Again, you see a big Canadian company coming in the top 10 here with Royal Bank, TD Bank. You're going to have a mix of both. In fact, you're going to have a mix pretty much across the entire globe, with 45% of the fund invested in America, 25% invested in Canada, and then you're going to see exposure to some global countries, some international countries that you otherwise wouldn't have got by just looking at these first 2 ETFs. So if you're somebody that is, let's say, bullish on, the global market, or you want to have an increased level of international exposure, this could be a very, very suitable fund. Now, one thing that I will mention with this fund, as titled by the name, the iShares Core Equity Portfolio, this is 100% weighted to equities. So there's no bonds, there's no fixed income. You have $100, all 100 of that is going to be invested in stocks or more growth type assets, which again may be very suitable for those striving for growth or okay with a little more volatility, and they're looking to essentially accumulate and grow their wealth. The next couple options, I think, will answer that question elsewhere. Performance-wise, this is a relatively new fund, so we don't have a whole lot of data, but it would be right in the range of what you'd expect out of some general equities. Again, if you think about it, it's really just owning, these 2 funds, their version of it, plus an international fund, plus a small emerging markets fund. Therefore, you'd expect the returns to be, long-term. Obviously, year to year, it's very different, but long-term, you'd expect it to be in that very similar range. Very important here to touch on fees. This is the higher fee product, which we will see right here. We see a management expense ratio of 0.20. So 20 cents on every $100 you invest. Again, in the big scheme of things, peanuts in my opinion, but you can do the research and make that assessment for yourself if these fees are getting too high. These are still very low cost index fund, index ETF investing strategies, just to be very, very clear. But obviously they are a little bit more expensive than just the broad-based funds because there's more that goes into it. Okay. Now, the last fund that I want to quickly share with you guys in this video, and again, I believe another staple that maybe a lot of people wouldn't talk about or a lot of channels may not consider. This one's ZAG or ZAG. Again, looking at BMO here as the provider, and this is the BMO Aggregate Bond Index ETF. Now, up until this point, we've been talking about equities or stocks, so baskets that invest in various stocks. Well, you can have an ETF that does exactly that, but invests in bonds or fixed income, a debt style of vehicle. And these are certainly more on the conservative end. I would argue right now, as of filming this video, interest rates have obviously climbed from where they were over the past number of years. That means that these typically will be offering, I would say, more attractive yields. And I think more so than the yields, these serve as kind of like the protection aspect of your portfolio. Okay, so especially if you are not as comfortable with risk or not as comfortable with volatility, maybe you're somebody who's getting older in age or approaching retirement, having an an element of your portfolio exposed to a fixed income ETF, I think could be a very, very wise choice. Again, do your own research and due diligence, but very briefly, we're looking at, again, nominal fees here, 0.09%. Obviously, we see the income, higher up. This is actually the highest that we've seen on our list today, thus far, 3.55%. Distribution. If we scroll down to the holdings here, we see this fund holds almost 1,600 investments, but these are all fixed income type of investments or bonds or essentially debt style investments. Again, you don't have to get into the nitty gritty of each of these bonds or understand what they do. That's actually one of the major benefits as well of using ETFs, is that you can essentially pick the right ETFs and trust that they're tracking a good index or they're constructed well, but you're essentially going to see a huge mix of government bonds. Actually, here we see a breakdown of exactly what bonds are owned within this fund. We see here federal bonds making up the largest component, 40%. So this is literally, government bonds. We see provincial bonds as well coming in at 33%. We see corporate bonds coming in at 25%. So this is, a company that may be borrowing money via a bond. You're getting a very healthy mix of this. This is entirely exposed to the Canadian market. And very important here as well, you have a healthy mix of different maturities or essentially terms or length of these bonds. A pretty even split here, but you have some more shorter term bonds, 1 to 5 year maturity, 5 to 10 year maturity, and then some longer term bonds as well. So the case in point of why I've selected these, 4 ETFs in particular is these are the types of funds, in my opinion, where you can buy them and just let them go for the next, number of years, for the next 5, 10, 15, 20 years. If you're a younger individual like me, you're getting exposure to the popular regions or areas or pockets that investors would look at, whether that be the S&P 500, the US broader market with VFV, whether that be the Canadian TSX market with ZCN. Obviously, like I said, the Xqt is that all-in-one package. Well, here you have a bond fund as well that you could consider to get you access to that fixed income portion. These markets, at least in my belief, are going to be here 5, 10, 20, 50 years down the road. Now, obviously, the constituents within each of these will change and companies will come and go, but that's the whole point of an ETF, is that you're diversified. You're essentially playing the entire market rather than making individual picks. I will finish it off with a quick little bonus one here. An interesting one from Global X, just as a bonus to throw in. Everything we've talked about up to this point, I would consider great long-term holds for a beginner investor. Well, if, for example, you wanted maybe a shorter term place to park some cash, for example, you didn't feel comfortable investing in the equity markets or even a bond fund, for example, although they are very conservative, they do still, they are subject to swings. Obviously much minor, but a very strong consideration, I think, as well, that you could throw on your list is the Global X Cash ETF, the high interest savings ETF. And this is a very interesting one, but it does pay a relatively attractive yield today at 4.55%. Again, one of the benefits of higher interest rates. But this is a very interesting fund where essentially cash invests almost all of its assets in high interest deposit accounts with one or more of the Canadian chartered banks. So this, in my opinion, could be a very suitable fund if, for example, you have money for a down payment that you're going to need to tap into, or you're going to pay for school, or you just have a shorter term need, or you're not necessarily sure what to do with it. Well, in the meantime, pop it into a fund like this, where you can earn some, very nice and essentially, I want to say, risk-free yields. Obviously, every investment comes with its risk, but in general, you'd even see this is considered a low risk rating, and you're pulling in a 4.5, 5% yield today. Obviously, as always, you need to be sure to do your own research and due diligence. The investments that we talked about today, these are just some of my favorites on my list that I think would be suitable. You need to make that decision for yourself, whether they are by going through, having a read. I'll link these all down below for you to go check out. And just learn more and do research and make the assessment of whether these are good funds for you. If you're new to the investing space and wanting to learn more, I'd highly encourage you download our app, Blossom. It is completely free. In fact, on Blossom, the second most popular topic in terms of the various things discussed are ETFs. So if you're an ETF lover, we have over 117,000 investors following this topic and chatting about their favorite funds, sharing what they're invested in. Blossom is a completely free app to download, and I really think you'd enjoy it. It's a great resource to have to complement videos like this and to be amongst a community of Canadian investors. There's a link down below where you can maybe scan the QR code or go to the App Store. Like I said, it's completely free to try it out, check it out, and see what you think. But I'd love to hear what you guys think of my selections today. Do you own any of these ETFs? Do you like them? Do you have better suggestions that you can share with the viewers? Please don't hesitate to leave a comment down below and let me know what you think. Like I said, these are some of my all-time favorites, and I think very suitable for beginners. But I'm definitely curious to hear what you think down below, so do not hesitate to drop a quick comment. If you enjoyed, give this video a thumbs up. Appreciate you sticking around to the end. And as always, I thank you for watching. I hope you enjoyed, and I'll see you in the next video.